I've called this strategy super scalping just because I've never seen anyone trade like this, but please let me know if this is how you trade. In the background, what you are watching is me trading this intense and fast-paced style on one micro NASDAQ futures contract. That channel's in the description. I'm going to cover literally everything, because this is for the benefit of both you and I. I have no interest in following the same path that everyone else does in a job with a 98% failure rate, so I've decided to learn through trial and error, tons of notes, and lots of reflection. Essentially, super scalping is an almost computer-like way of trading. Instead of going for big structural changes in the market, we are riding the small waves that it takes to get there. I don't care where the market is going to be in 10 minutes. I look at how big the candles are, use ATR to choose a good bracket order size, and then I jump into a trade thinking about which direction is most likely to happen next. It requires extremely dynamic thinking and constantly switching what you think will happen next, but we'll get into the mental side and everything else later. We are going for very small moves and not asking price to do too much. First, some brutal honesty because I'm not here to sell you a course. Don't be dumb. Hopefully this is the style that I'll stick with for a while, but you never know. Just like some of you might hate the idea of trading like this, which is fine. Personally, I hate the idea of trading supply and demand or swing trading. Yet I don't disparage certain styles of trading just because it doesn't suit my own narrative and personality. This is very intense, and we are all built differently. I'm not worried about offending the people who act like this because that would require them to be self-aware. Your edge might be in a more methodical and systematic approach where you're taking a couple very calculated trades only when the structure of the market lines up with your system. Perfect, that's great. Super scalping is a bit more like flying a kite in a tornado, which also works. Price action has been a bit of a mystery to me so far. On one hand, I thought I needed lots of direction from very few candles to make it work, but recently that's changed. Super scalping can be done when it's actually moving somewhere, as seen in the bottom picture, but it can also be done when nothing is really happening, as seen in the top picture. However, if you don't properly read price action to change the way you approach trading it and the way you position the bracket orders, then you will be destroyed. So what does that actually mean? For the sake of this trading style and video, I've broken price action down to two categories, because that's pretty much how it is when you simplify it. Price is either staying in the same area and consolidating, or it's making meaningful directional movements. Everything it does is some combination of the two. We can expect certain price behaviors and can make mathematical assumptions based on what's happening. Picture a trend and then picture consolidation. Obviously, you wouldn't trade these two the same. With super scalping, this idea still applies. When price is staying in the same area, that means you need to make sure the bracket order size is completely inside where price is staying most of the time. In consolidation, it's literally maximum stupidity times 10 to go long with a stop loss inside the zone and a profit target outside of it in this strategy. I know this from personal experience and from reflecting on how dumb everything I did was. You can see the trade entries and exits in these pictures, but just ignore them. Think about the fact that you're asking price to make an exception this one time if your trade idea requires a candle to break the pattern. So, when price isn't moving much, neither should the targets and stop losses. Expect price to continue what it has been doing until you're proven otherwise. Trading in consolidation means you basically need to be like a support and resistance algorithm. You don't need to perfectly execute every bounce off of everything, but there's still a ton of movement going on in consolidation as long as your entries are good. There are always waves of back and forth going on. This strat has nothing to do with where you think price will be in 5 minutes or even just 1 minute from now. This is trading the chaos with good risk management, but we'll get into that later. This section is just about trading in consolidation. Essentially, don't be stupid. Think about where price is most likely to go next based on what it has been doing only very recently. It's more likely to go where it's already been instead of to somewhere new, so use that. Additionally, I've found that it only works when your entries are really good. They need to be good in order to clearly skew the risk-reward ratios in your favor. This means shorting at the top and entering at the bottom, rather than waiting for a red candle to turn green somewhere in the middle to go long. Obviously, this is hindsight looking at these pictures, but I drew two zones to show you where price has been most of the time. Perfect entries would not be inside of the zones, or at least on the extreme edges. If you go long at the top or short at the bottom, then you're taking a super low probability trade and asking too much of price. In consolidation, your trades are based on the assumption that price will return to where it's been. You have to be contrarian instead of following it, which can be a little scary and almost feel counterintuitive sometimes for some reason. Maybe not to some of you. Also, I don't actually draw rectangles while I'm trading. Consolidation is too dynamic to put it in a box, both literally and metaphorically. Then we get to price action where it's actually moving somewhere. Up until episode 43, I thought this was the only tradable price action. I even had a picture of consolidating price action with a note that said, "This will kill you." When price is actually moving somewhere, the approach we took in trading consolidation has to flip. Suddenly, it becomes more likely that price will go to a new spot instead of hanging around in levels it's been at for a few minutes. This means that profit targets can be put in new spots without it being an extremely low probability and stupid decision. This is the action where maybe we can even catch a slightly bigger move. But don't be too greedy. Essentially, just understand that the approach we take in super scalping is unique to what price action is doing. So identifying which part of the spectrum of consolidation to meaningful movements it's on is the most important part. In a way, when there's direction, it can almost feel easier to read. But it's probably not. More likely, it could just be easier to look at in hindsight and think about all the ways we should have won every trade. All the types of price action are tradable with the right amount of volatility, since I've demonstrated this to myself. I just didn't fully understand how different my approach needed to be based on what price action was doing. Instead of only trading when it's behaving one way, just trade it all the time, but adjust the approach based on what's happening. Or don't, whatever. At the end of the day, if you find yourself only doing well with one type, then obviously stick with that and become an expert in that. Alright, so base your profit target and stop loss location and size on which part of the spectrum price action is currently at. However, all that stuff about price action is only half the puzzle, and I cannot emphasize the importance of that, which we'll get into in a sec. Consolidation ends, but so does directional price action. I've caught myself a few times trading as if price was still actually going somewhere when it had clearly gotten into a range for a few candles. If you are trading with the approach we take for directional price action and it starts consolidating, suddenly you'll just get stopped out for a loss every time because price is no longer moving to new areas. I love this picture because it perfectly demonstrates everything I'm talking about. I had 3 break-even trades, I think, in this consolidation. Why did that happen? Because I was trading consolidating price action, yet entering in the middle and putting targets in new areas. It's really hard in real time to actually figure out what kind of price action is going on, so it's not like you're going to instantly know how to approach it. However, over a series of trades, you'll have a pretty good idea about what's working and what's not. So after 3 bad trades, I actually caught a 16-point trade going short. I put the profit target a few points below the recent low, since the Nasdaq loves breaking recent highs and lows by a few points before coming back up a little bit. Whatever happens after that, I don't care. But I know I'm taking a high probability trade just going for a few points above or below a pivot. Whether it continues that way or completely reverses, I only care about the brief moment inside of that price action that will most likely happen regardless of the eventual outcomes. I then shorted again and got greedy, having a trade 9 points in profit become a 2-point loss. Doing that a couple times completely ruins the profit of catching a home run, which is why I'm currently just trying to hit singles and small trades instead of catching a big move. Anyways, I just wanted this picture to demonstrate how the trading approach needs to be extremely adaptive, because the spectrum of consolidating or actually moving somewhere is constantly changing. Moves a lot, moves a little, goes nowhere, moves a little, moves a lot. You get the picture. I use ATR to decide which bracket order to use. From this picture, you can see all the different names. Also, I enter with market orders. The style is too fast-paced for limit orders to be viable. The first number is how many points the stop loss is, and the second number is how many points the take profit is. And obviously, if you want, you can use that to see what the risk-reward ratio is. When I buy or close, 2 orders are submitted at the same time to automate the trade. Sometimes I'll move the take profit a little further away, and I only ever move the stop loss closer to the entry. The volatility of price action changes, so the size of the take profit and stop loss need to adjust with it. Obviously, I go to the bigger bracket orders as volatility goes up. The 2 and 3 bracket might work great at 11:30, but doing that at 9:50 would be stupid and terrible. You would just be getting stopped out instantly. A 5 and 6 can be great in the morning. Nice and reasonable, not asking price to do too much, and finding a good balance with what's most likely to happen next. However, that would be dumb to do at 10:50 on most days. That's because your take profit and stop loss would be too far away, which is fine, but that's not super scalping. Now that I've been trying this just a couple minutes after market open when volatility is the highest, the 5 and 7 bracket order can be a great choice as well. Super scalping is all about adjusting those order sizes so that you're trading the waves that happen inside the channels of price action. Whether that channel is moving up or down or sideways, we're going back and forth many times per minute or however often makes sense on that specific day, in that specific moment. In all the trades I do, the profit target is always higher than the stop loss. I'm still experimenting with all that and figuring out what's best, but I think for now it's just about making sure the stop loss is the perfect amount. It needs to be big enough to not get taken out instantly, and it can't be small enough where you're needing to be right at that very moment about where price will go next. It needs just a tiny, tiny bit of wiggle room. From there, the profit target should go in a spot where you're not asking price to do too much. Singles instead of home runs. I'm trying to constantly think about which line on the chart price is more likely to go to before going to a different line, aka the stop loss and take profit, which is what the hot tub video I made in the top right is all about. That video kinda sucks though, don't watch it. In a scalping approach like this, where a bracket order with set targets for the take profit and stop loss is used for each trade, how many points away the entry that those orders should be is constantly changing. This is because if volatility is low, we go for smaller moves. If it's high, we go for bigger moves. What's happening with price action is still the same, except the equivalent moves are happening more or less intensely. Price action remains relatively the same, except how far up and down it goes is different every day. That means we can use the ATR to read the volatility of each candle in order to decide what bracket order size to go for. Think about sound. When you sing a note, the distance between waves is reflective of that. But when you get quieter or louder, aka more volatile, the height of those waves change. Remember, it's still the same, except it's just a more intense version of itself. Huh? Like that one? Besides obviously needing to slowly develop the intuition on how to learn like this, just like in any trading system, which will take a long time, the mental side of this could potentially destroy some people. This is especially true if you have poor impulse control or/and low emotional intelligence. If you want to understand research-backed science about how the brain works so you can have an accurate understanding about how to learn how to trade, then click the video on the top right. Anyways, I find it funny to see how intense this is, yet I feel so much better psychologically and physiologically than I did when trading some more conventional styles. The most important part of this trading style is being dynamic in your thinking. It requires constantly switching your beliefs about what will happen next, and this aspect of it is especially tested when the trade doesn't go your way. In the same way that you can get into the flow of everything for a few minutes, you can also get stuck in a loop of being wrong on literally every trade, which I have done on my actual trading account. But that video is only on Patreon. If you want to see me at my worst, it's going to cost you $4, buddy. Sometimes you just aren't in tune with what's going to happen next in these short moves and all the fluctuations. What the fluctuate? Stop when you need to, go nuts on the chart, and don't overthink it. You can't overthink it because that would imply that you actually know what's going to happen next. Like what would you be analyzing? We can only make guesses with good risk management until we actually develop some intuition, which takes hundreds to thousands of hours. For example, if price is slowly going up and you go long after a little pullback but get stopped out, you then have to accept that you were wrong and immediately move on. Then you decide whether it's smarter to just follow the pullback or to try going long again, or wait. This is something that we learn through intuition, so obviously I don't just have an answer for you. That was a hypothetical question. That's not something you'll hear from all the trading YouTubers though. This is just one of the things you should be focusing the learning on. Also, if you want to learn what flow is, which is a real topic in psychology, click the video in the top right. Don't watch it now. Watch it after. Actually take notes and do reflections using data. You can't just learn by never mind. The market doesn't care how you feel. Futures don't care about your feelings. Know what I'm saying? Another big aspect of super scalping is being contrarian. I'm pretty tired. I read that as being a librarian. Sometimes you want to just follow the candle. But since we are trading the noise between structural market changes rather than the structural changes themselves, back and forth is constantly happening while these directional moves are going on. Jeez, So sometimes you're shorting as a candle pops up, or going long right after a candle drops down. You can sort of think of it as regression towards the mean, or just betting that the candle will return to a recent spot before continuing or actually reversing. Whether or not a red candle comes back up and then continues going that direction for a long time is irrelevant. The thing we focus on is that there's a good chance it will at least come up a little bit before either going back down or further up. Being realistic with profit targets rather than trying to catch a home run trade is essential. That part of the system probably gives me the most trouble. I get greedy sometimes trying to grab a couple more points, and that usually just turns what would have been a decent win into a loss. Of course, this is also dependent on the price action. If it's chopping back and forth in consolidation, then being contrarian is the way to go. If price action is making meaningful directional moves on each candle, then being contrarian is probably not the way to go, or at least less effective. When it's actually going somewhere, if you try to short each pop up, it usually doesn't work unless your entries are immaculate. I'm trying to break this habit myself. In this type of price action, playing follow the leader is the way to go. In some ways, I have a harder time trading in price action that just goes one direction for the most part. I think part of me feels like it's just too obvious and easy, and so instead of just buying each drop down and expecting a small move back up during an uptrend, sometimes I'll try to short on the pops up and just end up getting stopped out. For me, it seems like I'm working against my brain. We see a candle move down, and that thing called brain that named itself goes, ooh, short! Or when a candle pops up, we go, ooh, go long. But that just leads to failed trades almost every time due to the nature of what trades we're going for. These pop-ups and drop-downs usually come back the other way for the most part, so, well, I mean, I guess it depends on type of price action. Orange man with brain gears, gray check mark. On one hand, everything I've said here is like, yeah, good points, definitely. Yeah, sure, whatever. On the other hand, this trading style is so incredibly discretionary that if you start introducing too many rules, you will just wipe away the entire edge. After a little while of trading like this, I started getting worse, and then I realized it was because I was trying to quantify literally everything. I was collecting data on every decision, trying to find correlations between the good and bad trading sessions. Then I was like, you're overcomplicating this and thinking like an indicator. If indicators don't work on their own, then why are you trying to mentally create one? So I went back to the roots of the strat, made these notes to look at, and I started doing really well again. Creating a ton of rules for a discretionary trading style makes as much sense as being discretionary in a completely rules-based system. It makes no sense and ruins the edge that the two approaches have on their own. And obviously there's hybrid systems, whatever. It's not the point. Listen to that again if it didn't make sense. On screen are the things I look at, but these notes should be constantly changing. We look at reminders until they become automatic, and we make new ones as we identify new thought patterns or roadblocks that are hindering our progress. If the reminders you set for yourself aren't constantly changing, then are you growing? Are you learning anything? One way to quantify learning trading is to just look at how much your notes have changed. You're obviously learning something if the problems you're facing now are different because you've defeated the problems you used to experience. It can be tough to go for such small targets on a trade because we always have that little gamble bone in our brain going, but if you just caught one big trade, think about how much money that would be. Or at least that's what I have. You know, you only have to get lucky once. Yeah, but that's also the thought process that makes people buy lottery tickets. There's a very fine line in trading that separates you from someone just gambling. You might have been reading these little jokes and are thinking, "Ay man, why are you so mean to your viewers?" And to that I would say, shut the fuck up. I'm just kidding. A quick note about the bracket orders, stop losses, profit targets, and whether or not to set up an auto break even. No. Well, I don't know actually. Well, I sort of do. Making my stop loss automatically move to break even plus a little bit has made me miss out on more money than it has saved me from losing money. That means that most often it would hit the auto break even, close the trade, and then go to the original take profit instead of where the stop loss was. When I first started, having it do this was actually beneficial because I was trading in price action where that move was either going to happen now or not at all. So it would hit the break even stop loss and then go down a few points to where the stop loss was originally, saving a few points each time. In those instances, it was advantageous, but lately it has not been. So I submit the order and only ever move the take profit a little further up or move the stop loss closer to break even. I'm constantly thinking to myself, which line is it most likely to go to before going to a different line? What you need to remember is all that trading is when you have a stop loss and take profit level. This is something that's constantly changing for me, and sometimes I make the dumb decision of moving the stop loss to try and lock in profits, which almost never goes well. This trading style can probably be done with stocks, options, or Forex, or crypto, but whatever you're trading needs to be very volatile. How are you supposed to catch tons of little movements if the thing you are trading is barely moving? You know, like this wouldn't work on ES, at least not for me. Volatility means trading opportunities, so trading the NASDAQ is perfect for this. On futures, I'm trading /MNQ here, which is the micro version of /NQ. The micros move the same as the minis, but are 1/10 the size, which is great for learning. The only problem with super scalping the NASDAQ on the micros is that the commissions make it seem like it wipes out the edge. This is because the commission to point ratio on MNQ is about 1 to 2, $1.12 total in commissions to $2 per point, whereas on the mini it's 1 to 5, $4.08 in commissions to $20 per point. So the P&L on the micros are extremely skewed by the commissions. Those commission numbers were the total for opening and closing the trade, not per side. And that's the rate for NinjaTrader if you own the lifetime license like me, which I bought for $1,100 because that's how much I like the platform. Also, the cost reduction in commissions will be very important long term if I'm taking like 10 to 30 trades per day. The important one. How rich can we get? Someday in the future, I can see myself with a modest position size of 6 super scalping the NASDAQ mini contracts. Let's say I scalp the morning session taking 15 trades. Let's say that the volatility in ATR showed me that the best bracket order setup would be a 4-point stop loss and 5-point take profit. I win 9 of the trades and lose 6 of them, meaning I've won 45 points and lost 24 points. At $20 a point and 6 contracts, that means I would have made $2,520 with only winning 9 of the 15 trades. Commissions would be a total of $367. Oh no, that would mean I'd only make $2,000 by 10 a.m. and free up the rest of my day to do whatever I wanted. Oh no, freedom. The commissions are there, but they don't wipe out the edge, so there better not be any ooga booga but commissions comments. If you actually have real experience trading large size on NQ in the morning, please let me know what size starts to experience bad slippage, because I can't find a consistent answer online by anyone who actually knows what they're talking about. Okay, you've probably noticed that there are no indicators. Think about why that is. Good job. Why the heck would I care about being under a moving average when I'm trading the noise and the trades only last seconds? We aren't trying to predict where the market will be a month from now, a day from now, or even 5 minutes from now. I care about right now, this very moment, and nothing else. I pointed my fingers at the screen just to really reinforce that. As for time frames, I'm trading off of a 20-second chart. That one in the bottom left is 5 minutes, and I basically just look at that to make sure I'm not like taking a trade at some weird level or something funky might happen. This is my favorite right now, but I wouldn't go any higher than 20 seconds. It actually reminds me to continue trying lower ones just to see if anything feels better. Thanks, writing that down now. To anyone saying that's too small of a time frame, please think about why you actually believe that and then figure out why that doesn't make any sense. So when to trade? Well, as you figured out by now, / me saying it wow, never mind. You know that we need some volatility. So with that in mind, when do we get the most volatility? That's right, market open and just after that. When I started, I was trying this around 10 just to let things calm down a bit. But recently I've been trying a couple minutes after market open and finding some success. Right now, a 5-point stop loss and 7-point take profit bracket order works well, but sometimes I have to make that smaller to match volatility better. If it gets any higher than that, I just don't trade, since the potential losses of not doing well are a bit too much for my current situation. I'm not rich. I make videos that actually help people, not... Remember, this strategy only works if you actually adapt your trading size based on volatility. This concept of using ATR to adjust the size of your targets is probably one of the most undervalued concepts in trading. And I don't know why it's not talked about more, but I get it. The video in the top right is much less interesting than the secret mindset uncovering the next breakthrough on how the market secretly works. I'm not mad, you're mad. No, you're projecting. No, you are. So the next part of this is like, when do you actually stop trading? Well, regardless of the trading strategy, you should obviously stop if you get really tilted to the point where making a stupid decision becomes likely. If you're mad, don't be an idiot and keep trading. Take a break. Count to 10. Do whatever it is that you need to calm down. Punch the drywall. Grab the demon that lives in your walls. Tell him to quiet down and then put him back. I don't know. Before, I was taking a break once price action started consolidating. I would try to only trade when price action was making meaningful directional movements. But, as I've said, recently I found that I could trade consolidation just as successfully as long as volatility was high enough. I just needed to adjust the approach and expectations. So, essentially, I can just trade until I get tired. Either that or trade until you realize you're probably down a lot on the day and should just stop, which I know all too well. You have to find the balance between stopping because your trading is just off and just stopping because you're too focused on the P&L. You know how it is. That's not what this video is about. Sometimes I trade this for 3 minutes. What? For 3 minutes. Sometimes I trade for like 8 minutes. Sometimes I'll do a couple minutes and then take a few minute break before getting back into it. It sort of changes by the day, but hypothetically you would just trade this until volatility died down to the point where it didn't make any more sense to continue. Even if price action looks like it did earlier, except it's just barely moving now, sometimes volatility is just too low. I stay away from this, but perhaps you'll find lower volatility super scalping easier. You have to actually do some experimenting, because the way I approach this style is personalized to be somewhat reflective of my unique self. Because I'm super special. Make it work for you like I've made it work for me. Can you trade like this? Sorry, it's italicized. I've seen lots of comments from people describing in various ways how this style is just too intense and can't be done. Ooh. I stopped myself from telling them that they have main character syndrome and that not everyone's the same, but At the same time, this probably can't be traded by everyone. When my mom is texting on her phone and I ask her a question, her response will only happen once she's done typing out the message, even if it's a yes or no question. Like literally a 10-second delay. I'm just standing there like this, waiting. And then she'll respond as if it hadn't just taken 10 seconds to respond. It's like a reality just paused. The brain isn't capable of multitasking in the sense of watching a movie and studying for a test with perfect retention for both. You can't just split it in half. But there is also a bit of a spectrum to doing things at the same time. If you're like my mom, maybe you can't trade like this. Maybe you can. I don't know. I play Rocket League in the top 0.5% of ranked players while listening to a podcast at the same time and retaining it not 100%, but a lot more than the average person. Watching TV is tough for me because it's not stimulating enough. Most of the time, it's boring. My leg or something is constantly shaking because if tons of things aren't happening at once, I get really restless. There are very few activities in life that actually stimulate my brain to a level that I think most people experience with normal activities. I'm currently writing this at about 80 words per minute while also listening to a bunch of people singing a cappella harmony choir music. I don't even know how to describe it. VOCES 8 for anyone wondering. Incredible group. According to my Spotify Wrapped, I listened to over 79 different genres this year. I didn't know there were that many either. Anyways, the reason I'm saying all this is because while most of you are thinking of this strat as too intense and fast-paced or as needing a computer-like brain to switch biases and make decisions so quickly, the small percentage of people who are like me are just thinking, okay, cool, so it's just like an intense match in a video game where I finally get to actually use all my focus, all my brain power. We are all very different, and I've talked before about how I think we sort of gravitate to a trading style that's somewhat reflective of our personality. Super scalping is definitely reflective of me. For some of you, maybe supply and demand is more reflective. It's fine, whatever. Yeah, we all find our thing. Slow, calculated, and methodical, whereas super scalping is like a few minutes of complete chaos, making split-second decisions, improvising, adapting, and hyper-focusing. Once I realized I could use this part of me as a superpower, I started waiting until the last possible moments to begin assignments in college. Many of my greatest works were all completed on the night they were due, or the night before I had class the next day to turn it in. When I was forced to actually focus, I could complete things with the same quality in less than half the time. It was a great breakthrough, allowing me to basically just play video games all the time while also remaining a 3.9 GPA. But who's counting? Who's keeping track? I am. Okay, but enough about you. Let's talk about me. On my setup, I have the daily candles up, but I don't really care or use them. I just like seeing where the market's at. Price action can get funky when we get to somewhat important levels or zones where what happens actually means something, so I just avoid them entirely until the typical market noise returns. Yeah, I don't know why that's in this section. It's supposed to be in the other one, but I don't care. Okay, everything. Adjust the bracket order size based on the current volatility, which is different every day, every moment, every second, every. Adjust your trading approach based on what price action is doing. Duh. Is it consolidating? Is it making meaningful directional movements? Or is it doing some combination of the two? Each type of price action requires a different approach because stop loss and profit target locations need to be reflective of what's most likely to happen next. And what's most likely to happen next is a byproduct of the type of price action. That's why it's so important to identify it. Do not overthink it. Constantly switch your beliefs about what will happen next and hyper-focus on what you really think is most likely to happen next. Seriously, actually think about that over and over. This was a big video and it took a lot of work. Thank you so much to my patrons who helped motivate me to make all of this happen. Alright, thank you, and best of luck to you and your trades, unless you're mean.